AT&T, stock ticker T, is currently trading at $19.80 per share, and we're actually just a few days away from their upcoming quarter's earnings. We can see their announcement date is going to be on April 20th, so we're just a few days away. Now, if we jump over to our summary, this is actually a company that I've kept up with for a very long time. If we look at the past 6 months, it's quietly performed extremely well. It's up over 29%, and over the past month, it was up around 8.44%. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of AT&T and decide if it's a stock we should consider buying at its current price. And like always, we'll be looking at a few different valuation models. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So let's go ahead and come up here and plug in the stock ticker T and hit enter. And you can see all of this data will automatically load in. So you can see there was a huge drop in its share price, but since then it's bounced back up quite a bit. Now coming over here, we can see they're currently paying out $1.11, which gives them a starting dividend yield of around 5.6%. Let's go ahead and jump back over to Seeking Alpha and jump into that dividend just a little bit more. And if you've been keeping up with the company, you know they did recently have a dividend cut around a year ago. So you can see they were paying out around 39 cents per share quarterly, but that has jumped down to around 28 cents per share quarterly. And it looks like, according to our history right here, that the management is currently not looking to increase that dividend. It stayed stagnant for quite a few quarters now, so it looks like the dividend has not been increasing as of late. So yes, good starting dividend yield, but you shouldn't really expect to see any dividend growth in the short term right now. Analysts currently have a target price of $21.13 per share. Institutional ownership is actually pretty low for a company this large, around 54%, and a very low beta, only sitting at 0.67, so you should see very low levels of volatility. Now, the first valuation that we will look at is going to be Benjamin Graham's valuation. And here's the formula he lays out for us to calculate intrinsic value. So you can see we need to plug in our earnings per share. We need to plug in our growth rate projection. For a company like AT&T, they're going to have a pretty low growth rate projection, and you can see I'm staying in line with analyst expectations, applying a growth rate of 1. We then multiply that by 4.4 and then divide that by Y, which is the current yield on AAA corporate bonds. And at the time of this video, that is sitting at 4.28. So that gives us an intrinsic value of about $20.15 per share, just a little bit higher than that current trading price. Now let's go ahead and jump over to our discounted cash flow analysis. And typically we plug in all the historical free cash flow for this company, but in this situation, we're really only gonna look at the prior year, since before that they actually had their spinoff with Warner Media, so it wouldn't really make sense to look at that free cash flow. But moving forward, I'm projecting a 2.5% free cash flow growth rate. So I'm projecting that to all the future free cash flows and the terminal value. We then take the present value of those future free cash flows and add them together here, add the company's cash and cash equivalents, which has actually decreased a little bit over the past couple of months, and then we subtract out their total debt. Now the total debt is what a lot of people are still concerned about. It was reduced a little bit when they did spin off Warner Media, but as you can see, it is still a very large amount, so a little bit of a red flag there. Once we do that, we get the equity value, divide by our shares outstanding, and come to a discounted cash flow price per share of $15.74. Now, there's obviously a lot of different variables at play here, such as our growth rate projection, but really the total debt, again, is what's driving down this valuation so much. If it was a little bit lower, like most companies, this valuation would probably be closer to $20 per share. Let's go ahead and move forward and look at our multiples valuation. In this scenario, we really don't have a whole lot of great comparables. Really, Verizon is the only company I feel comfortable using as a multiple for this valuation. But when you only have one multiple, it just doesn't really make sense in this scenario to use this valuation model, so we're going to be removing it. Now let's go ahead and move forward and look at our dividend discount model. And again, they did recently have their dividend cut, so I don't have that plugged in right here, but I do have the current dividend payout in. And you can see again, they're currently paying out around $1.11 per share. Now moving forward, I am projecting a dividend growth rate of 1.5%. Now right now, I don't think short term you're going to be seeing any dividend growth, but if this company can get back to where they want to be, I think a dividend growth rate of 1.5% will be pretty accurate. Now you can see after we plug in our discount rate, we come to a dividend discount model price per share of $16.12. But because this dividend growth rate is so low, let's say it's even lower, we'll plug in 1, you can see the dividend discount model jumps down to around $15 per share. So obviously, it's going to be really interesting to see where their dividend growth is in 3 to even 5 years from now. It's going to play a large role in this valuation, obviously. Now, jumping over to our output tab, we we can see the three valuations that we use. We use grams and came to an intrinsic value of $20.15, discounted cash flow $15.74, and the dividend discount model $16.12 per share. And when we plug all of that in, we come to an intrinsic value of $17.34 per share, a little bit lower than that current trading price. But if we were to apply a 10% margin of safety, you can see based upon that, our acceptable buy price for this company is around $15.60 per share, meaning it's not currently a stock we should consider buying. And if we jump back over to Seeking Alpha, we can actually see within the past year, there has been opportunities to buy within that range. They were trading as low as around $14.46 per share. Now, I think I made a video on this company when they were trading around that range, and I actually said it was trading at a decent value at that price, but you shouldn't expect to see a lot of long-term growth. And you can see I actually did back up what I said. I have a small amount of my portfolio allocated to AT&T. It's a little bit less than 1%, but since then I've seen pretty decent gains. It looks like I'm up a little over 7% on AT&T, so it's always nice to see a little bit of gains. Nice starting dividend yield, but again, a very small part of my portfolio is allocated to this position. Maybe it's something I'll consider selling out of in the future since I've already seen some gains, and I also want to see more dividend growth out of the positions in my portfolio. But there you go. There is a quick analysis on AT&T. I'll definitely be watching in the coming days to see what their earnings report has to say. But if you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.